The recent market volatility has made a lot of people uncomfortable, and that reaction is completely understandable, because what we are seeing is a combination of external uncertainty and internal price movement happening at the same time. On one side, you have global factors becoming more complex, including energy price fluctuations and rising risk aversion, and on the other side, you have a noticeable pullback in the market itself. When these two things happen together, it naturally raises a concern. Is this just a temporary correction or the beginning of something bigger? But if you take a step back and look at how shares have behaved over the past several years, there is a pattern that shows up more often than people expect. Since around 2018, the market has gone through multiple external shocks, whether related to global tensions, liquidity tightening, or unexpected macro events. And in most cases, the initial reaction is very similar, a sharp decline driven largely by sentiment rather than a fundamental shift in the underlying economy. This initial drop tends to concentrate uncertainty into a short period of time, after which the market gradually transitions into a recovery phase. And that recovery is not immediate or linear. It usually unfolds in stages. First, sentiment stabilizes. Then structural signals begin to appear. And finally, capital starts to reposition. Many investors struggle in this type of environment because they interpret short-term volatility as a change in long-term trend, but in reality, those two are often very different things. The current situation shares many of these characteristics. External factors are clearly influencing expectations, but when you break them down, they are not necessarily altering the long-term logic of most companies. What this creates is a gap. As expectations are pushed lower, the implied risk compensation entailed certain assets begins to rise, and that is often why sharp sell-offs are followed by a relatively clear recovery window, typically within 1 to 3 months. This is not a fixed rule, but more of a recurring rhythm, because it takes time for sentiment to be released, for capital to adjust, and for policy or economic signals to filter through. However, there is an important condition behind this pattern. The broader system itself must remain stable. If the shock is primarily external, then the market is more likely to follow this correction and recovery cycle. But if the issue is rooted internally, then the outcome can be very different. So the key question is not how much the market has fallen, but why it has fallen. In the current context, the drivers appear to be more related to external uncertainty rather than a structural breakdown, which suggests that what we are seeing is closer to a rebalancing process than a trend reversal. In this kind of environment, the challenge is not just deciding whether to act, but how to act. Many investors either rush to add positions during the decline or chase momentum during rebounds, but a more measured approach is to observe how different sectors behave during the process, which areas show stronger support during sell-offs, and which respond more quickly when sentiment improves. These signals often provide more insight than the index itself. At the moment, certain areas with clear long-term drivers continue to attract attention, such as infrastructure related to computing capacity, where demand is less dependent on short-term sentiment. At the same time, sectors with stable cash flow characteristics tend to serve as defensive allocations during periods of uncertainty. What this reflects is a natural balance within the market. Some capital seeks growth and flexibility, while some prioritizes stability and predictability. And the relative weight between the two shifts depending on the environment. For individual investors, a more practical takeaway may be to focus less on trying to identify the exact bottom and more on understanding the timing. When sentiment becomes extremely negative, a portion of the risk has usually already been priced in, but that does not mean the market will immediately reverse. Instead, it often enters a transitional phase where recovery gradually takes shape. This is why a staged approach tends to be more effective than making a single all-in decision. Another important aspect that is often overlooked is that position sizing itself is part of the strategy. Sometimes doing less can be more effective than constant adjustments, because the best opportunities often appear when sentiment has cooled significantly while fundamentals remain intact. And that is also the point where many investors hesitate due to recent volatility and end up missing the recovery. Ultimately, this type of market environment is driven by a mismatch between sentiment and structure. When sentiment overreacts, structure does not necessarily change at the same pace, and that gap is where opportunity can emerge, but only if you are clear about what kind of shift you are dealing with, whether it is a short-term disturbance or a long-term turning journey point, because getting that distinction wrong will lead to very different decisions. Based on what we can see so far, the situation appears closer to the former, which means patience may be more valuable than urgency. and allowing the market to reveal its direction can often be a more effective approach than trying to force a conclusion too early. Has